on and talk about Happiest Technologies. The stock is in focus on the back of its earnings. In fact, my colleague Reematendulkar caught up with the management. Let's listen in to that conversation.
Quick recap of what we have done through the year. 18% growth in total income, about 14% in rupee terms on operating revenues, and 11% growth in EBITDA. We have beaten our EBITDA guidance for the 16th quarter in a row. So if you look at it, compared to what the markets have been declaring, we have done a reasonable set of numbers. And in constant currency, we have grown at 11%, very close to the 12% guidance that we gave. So it's quite encouraging what we have to show as a performance for the previous year. Looking ahead, like you said, there are two acquisitions that we have done, Macmillan Learning and Pure Software. Macmillan Learning is a smaller one, which will quickly get integrated. And Pure Software will be, there has to be a planned process to get that into our story very quickly. While, like I said earlier, it's synergistic, it's EPS accretive, it's cash accretive, and it is business accretive. So it's accretive in all terms. So we are looking to integrate it very well into our business in the next 1 to 2 years, and then see how 1 plus 1 can be 2.5 or 3. As far as an estimate for the next year, I would hold back from using the word guidance because, there are a few moving parts here. The estimate of growth for the we are looking at 35 to 40% on revenues. This considers both organic and inorganic and a decent, very good organic growth as well. So it's not all coming from the inorganic acquisitions that we have done. And as far as margins are concerned, we would like to have a broad range of 20% to 24%, and then like to position EBITDA and operating margin going forward. Why I say that is EBITDA has a component of other income, and as you deploy cash into acquisitions, you have to see that becomes part of the business growth and business profitability, and you need to balance both of them. So that's why I'm giving a larger spectrum of 20 to 24% on margins, and as we have done, the idea is to meet and possibly beat those numbers.
Joseph, you want to elaborate? Venkat said that there are a lot of moving parts, which is why he's not using the word guidance. He's using the word estimate. What are the headwinds? What are the tailwinds? How is the market environment currently? And can you at least tell us if the organic growth in FY25 will be better than the FY24 organic growth without getting into numbers?
So if you just look at the market, Reema, and I'd break it up into 3-4 different areas. If you look at from a geo perspective, I think clearly one of the things that's coming across clearly is that India as a market and as a source of business is really looking very promising. There's a fair bit of investment that's being made. The economy, as you know, is doing quite well. Especially relatively speaking. So, and if you look at our performance also, the percentage of revenues from India has increased almost 3% on a year-on-year basis, and quarterly it's been increasing. So we will continue focusing on this market while balancing out margin considerations. So that's from a geo perspective. If you look at from a vertical different segments, there are a few segments that look like they're sustaining their spend or even doing quite well. Healthcare clearly is an area that is, and again it's borne out by our numbers, is an area that's seeing continued spend, especially on the digital side of pharma. Some of the medtech companies, they continue to make investments, and that's an area that we are focused on. In edutech, we're looking more at K-12 now because higher ed is still impacted. That's a headwind, I would say. But the tailwind in this segment would be on the K-12 side. And I would say high-tech continues to remain the same. There's not much movement. It's still cautious. If you look at retail CPG, the CPG part, there's a lot of investment going on in how to engage with end users, how to use technology to collaborate, to build networks, and use data and analytics more in decision making. Industrial manufacturing continue to see spends on modernization. So that's what I would call out. BFSI is still being a little cautious. So that's from a vertical perspective. And the last point I wanted to make, second last point actually, because the last one I will reserve for GenAI. The second last point I wanted to make is if you look at the way customers are approaching their spend, there is a bit of caution in how they are deploying their dollars and their budget. There seems to be more openness to getting into some of the road mapping and discovery consulting exercises. But once that's done, getting into implementation is taking a little longer, which is where you're seeing deal cycles getting elongated. The last point I wanted to make is on GenAI. I think there we are seeing a lot of excitement from customers. There's a propensity to experiment, to look at use cases. And I put them into three buckets. One is customers who have a strategy in place and they're trying to implement that. Second is customers who want to do something and have are exploring POCs and use cases. And the third is customers who want to do something but they don't have an idea what to do, right? And our offerings and our approach is catered towards these three segments, whether it's horizontal or vertical use cases. And we are seeing quite a lot of traction, 14 customers already, and many more where we're having discussions and prospects.
Okay. And just one final question then on the organic growth in FY25. Can it be better than FY24?
So, I would say given our pipeline and the market conditions and some of the segments that we are focused on, our goal would be to do something similar, if not better. Just like Venkat mentioned, on margin front as well, we've given our range, and we've always tried to do better than the goals that we've set for ourselves. So that would be the aim and goal, Reema.
Well, a very interesting conversation with the management of Happiest Minds. Let's talk up 3% in that session today. But let's now slip into a short break. We'll get you more